Welcome to the FIT video series, financial instruction and teaching brought to you by Severson Strage, a fee-only financial planning and investment management firm. How would you like to reduce your taxes, increase your retirement income, and benefit your favorite charity all at the same time? Severson Strage explains how that can be accomplished through a charitable remainder trust.
A charitable remainder trust, or CRT, is a very powerful tool that can be used to help reduce taxes, increase retirement income, and benefit your favorite charities. People who may benefit from a CRT include individuals who, 1, are subject to paying large capital gains taxes on appreciated assets, 2, would like to maintain an income stream from those assets, and 3, would like to benefit charities. A CRT is a tax-exempt trust that can liquidate an asset to create two interests, an income interest and a remainder interest. The income interest is paid out to a designated beneficiary, often the creator of the trust or the creator's family members, for a set period of time or for an entire lifetime. At the end of the trust term, the remainder interest, the remaining assets in the trust, are passed to the creator's charities of choice. My colleague Jaron will now share information about the benefits and potential income derived from a CRT.
First, appreciated assets are transferred into the trust. There are many types of assets that can be used, including appreciated shares of stock, assets of a business, or even farm machinery. In the case of farm machinery, often it has been depreciated over several years, so if sold outright, would be subject to ordinary income tax rates. However, if the machinery is sold under the tax umbrella of the CRT, there would be no immediate taxes due on the sale. In the case of appreciated assets or cash, the creator of the trust would also receive a very large charitable income tax deduction in the year the trust is created. This is because a percentage of the assets transferred will eventually pass to charity at the end of the trust term. In these cases, if the individual sold the assets, business, or farm machinery first and then gave the money to a charity, they would have to pay taxes on the sale and would not have the benefit of annual income. In regard to income, the creator of the trust specifies in the trust document the percentage or the amount of income that the trust will pay out annually to the income beneficiary, which is often the creator's family. The amount of income that can be paid out is flexible and is often stated as a percentage of the assets, such as 5 to 10% annually. For example, if a person had $250,000 in assets in their CRT and chose a 10% distribution, they would initially receive an annual income of $25,000. One nickname for this income stream is a charitable pension plan, because the creators of the trust can receive income much like a pension for the remainder of their lives. One potential additional tax benefit is that amounts transferred to a CRT are not generally subject to gift or estate taxes. Therefore, people with large estates subject to the estate tax could help reduce these taxes by creating a CRT.
Finally, at the end of the trust term, which is often at the time of death of the creators, the remaining trust assets pass to charity. At the time the trust was established, the creators specified their favorite charities to be the remainder beneficiaries. Flexibility exists to change the charities after the trust is established by naming a donor-advised fund as the remainder beneficiary. As you can see, the Charitable Remainder Trust can be a powerful tool to help achieve your financial goals and benefit you, your family, and leave a lasting impact through a charitable gift.
Thanks for joining this FIT video. If you'd like to see how Severson Strage can help you with this topic or other financial planning needs, contact us for a free, no obligation, confidential consultation. Call 515-225-6000 or visit onlyworkforyou.com. Thanks again.